Decoding economic fortunes, the pivotal role of the yield curve in predicting recessions and expansions. Introduction. Within the intricate realm of economic indicators, the yield curve emerges as a powerful and prescient harbinger of economic fortunes. Its shape, a graphical representation of interest rates across various maturities, holds the key to unraveling the mysteries of recessions and expansions. Investors and economists alike scrutinize the yield curve's subtle shifts, recognizing it as a reliable compass that points towards the trajectory of economic growth. In this exploration, we unravel the nuanced relationship between the shape of the yield curve and its predictive prowess in heralding economic recessions and expansions. The yield curve anatomy. The yield curve typically showcases the interest rates on government bonds of different maturities. In a healthy economic environment, the curve tends to slope upward, signifying that longer-term bonds carry higher interest rates than their short-term counterparts. This positive slope reflects the market's anticipation of future economic expansion, with investors demanding higher compensation for locking in their capital for an extended period. Conversely, an inverted yield curve, where short-term interest rates exceed long-term rates, paints a different narrative. This rare occurrence, often perceived as a harbinger of economic downturns, has historically preceded many recessions. The flat yield curve, positioned between the extremes of upward and downward slopes, denotes a neutral stance, leaving economists to scrutinize other factors for indications of economic shifts. The inverted yield curve's ominous signal. An inverted yield curve is akin to an economic oracle, foretelling the possibility of an impending recession. Investors, attuned to the historical accuracy of this signal, interpret it as a red flag for economic contraction. The inverted yield curve reflects market expectations of lower future interest rates, potentially due to anticipated central bank rate cuts in response to economic challenges. To illustrate, consider a scenario where the yield on a 10-year government bond falls below the yield on a 2-year bond. Investors, perceiving economic headwinds, flock to long-term bonds, driving their prices higher and yields lower. This flight to safety, coupled with expectations of lower future interest rates, manifests as an inverted yield curve, signaling a cautious outlook and potential economic downturn. Leading versus lagging indicator. The yield curve's unique characteristic lies in its dual role as both a leading and lagging indicator. In its leading capacity, the yield curve's inversion often precedes the onset of a recession by several months to a couple of years. Historically, this phenomenon has served as a reliable precursor, giving investors and policymakers a valuable window to prepare for economic headwinds. On the other hand, the yield curve also serves as a lagging indicator during the recovery phase of an economic cycle. As central banks implement monetary stimulus measures, short-term interest rates decline, and the yield curve may revert to a normal, upward-sloping shape. This lag reflects the time it takes for policy actions to manifest in economic indicators and underscores the importance of continuous monitoring. Global economic implications. The yield curve's predictive power extends beyond national borders, influencing global economic dynamics. In an interconnected world, the shape of the yield curve in major economies can reverberate across financial markets, impacting investor sentiment and capital flows. For instance, a synchronized inversion of yield curves in multiple leading economies may signal a synchronized global economic downturn, affecting trade, investment, and financial stability. Consider the global financial crisis of 2008, where inverted yield curves in the United States and other major economies foreshadowed the widespread economic turmoil that followed. Investors who heeded these signals were better positioned to navigate the challenges, highlighting the yield curve's role as a global economic barometer. Central bank policies and yield curve dynamics. The shape of the yield curve is not solely a product of market forces, it is also shaped by central bank policies. Central banks, as architects of monetary policy, can influence short-term interest rates through rate adjustments and other policy tools. The yield curve's response to these policy actions provides insights into the effectiveness of monetary measures and the perceived trajectory of the economy. For example, a central bank's decision to lower short-term interest rates may steepen the yield curve, signaling confidence in economic growth. Conversely, a series of rate hikes aimed at cooling an overheating economy may flatten the yield curve, reflecting the central bank's intent to prevent inflationary pressures. The interplay between central bank policies and yield curve dynamics underscores the symbiotic relationship between monetary authorities and market indicators. Conclusion. In the intricate tapestry of economic analysis, the yield curve emerges as a critical thread that weaves together past, present, and future economic trajectories. Its shape, whether sloping upward, inverting, or lying flat, communicates a wealth of information about market expectations, investor sentiment, and potential economic shifts. Investors, economists, and policymakers keenly observe the yield curve's undulating patterns, recognizing its significance as a reliable predictor of recessions and expansions. As we navigate the complexities of the global economy, the yield curve stands as a sentinel, offering valuable insights to those astute enough to decipher its subtle language and act upon its nuanced signals.